Hi everyone, welcome back to the US CPA classes for business analysis and review examination. In this particular video, I'll be walking you through in detail of prospective analysis including the use of data, and the specific topic we'll be covering is operating leverage and finance leverage in detail. So let's understand what is operating leverage and what is finance leverage and how to use it in a capital structure.
Hey everyone, welcome back to BR classes. So in the capital structure, we have already discussed on capital structure, risk, leverage. Now we are discussing the capital structure including WACC, weighted average cost of capital. So before we went on a break, we have already started studying on the weighted average cost of capital, and we did understand the capital structure, financial structure, and overall weighted average cost of capital. Then we discuss about optimal capital structure and order of financing. And then we discuss about review of capital structure in two basic model. One is EBITDA minus earning per share indifferent point, and second one is the debt to equity ratio. Then after we started understanding what is short-term debt, what is long-term debt, advantages, disadvantages, earning debt to earning equity ratio, interest earning ratio, and then we did couple of examples. Now we are understanding on leases. So leases is also like kind of finance basically, right? So what do you mean by leases? That means you are acquiring any property, plant, equipment, right? Either on operating lease or on finance lease. Like in both the cases, you get an opportunity to use the respective property, plant, and equipment which you are taking on lease, right? So leases, as we all know, are of two category, like operating lease and finance lease. But majorly finance lease is also being considered as a financing arrangement for purchasing of any asset, right? That is the reason that topic is being covered here in the weighted average cost of capital. So we'll be understanding what is leases, what is operating lease, what is finance lease, what is the advantage of finance lease, and what are the disadvantages of finance lease, and then what is the impact of the lease on the weighted average cost of capital. That we'll discussing, right? So very first topic, leases. What is leases? We discussed this many a time in accounting as well as in auditing, right? In BR also, like earlier we have discussed. But quickly, what is leases?
A contract between lessor and lessee.
A contract between lessor and lessee to use any
The asset owned by the
equipment,
lessor.
right? To use any asset which is a property, plant, and equipment. It can be short term or it can be long term. It can be considered as operating lease. It can be considered as finance lease. So first you need to identify the criteria of finance lease. If any particular lease does not fall into finance lease, then it automatically fall into operating lease. So first we'll be understanding right hand side, finance lease. When any lease is called finance lease. So finance lease is a method of financing, like we were discussing earlier, the acquisition of asset that is treated as sell by the lessor, right? Finance lease is a lease that meet any of the following five condition. That means out of these five condition, any one condition is met, then also that lease is called finance lease. If none of these five conditions are met, then it is considered as operating lease, right? So first condition is release term. Release term is a major part of the asset economic life. Lease term. It has to be lease term. Lease term is for the major part of the asset's economic life. For example, like in India, like diesel car has a life of 10 years, right? If you have taken the diesel car on lease for, let's assume, 7 year or 8 year, that means you are using majority of the life of the diesel car, right?
Yes, sir.
So then it is being considered into finance lease, not operating lease if you are using it majority of the economic life of the asset, right? Second is there is a transfer of ownership at the end of the lease term. So there is a possibility in the lease term, it is mentioned that at the end of the lease, lessee can acquire that asset at significantly less price than the market price, right? That arrangement is also considered as finance lease. Third is there is an option at the end of the lease to purchase the asset for a bargain price that is reasonably certain to be exercised. That means after the lease term, they will offer at the beginning in itself very significantly reduced price to purchase that asset. For example, if you have taken a car on lease, the car life is, let's assume, 10 years. So you have taken a lease for the period of, let's say, 4 years. So let's assume the car value, maybe let me draw an example, then it will be easy for you. So for example, there is a car, right? Value cost. Let's assume you have a car of costing, let's say, $250,000. You have like an F1 car. What is F1 car? Sports car,
Formula
right?
1.
Right. So you have a sports car which you have taken on lease, and lease rent you are paying. Let's assume 2,500 per month. Okay, and lease period. I would say you're paying it. Let's assume, yeah, at $3,000. Let's assume, just for ease of example. And the lease period is, let's assume you have 4 years, 48 months, right? So lease rent is how much? Is equal to 3,000 multiplied by 48, around 144. Yes
Yes,
or
sir.
no? Right? And then after 4 years, book value of car is, let's assume, depreciation rate 10% SLM. So what will be the value of asset after 4 years? Let's assume 10 years is the life. So after 4 years, how much will be the book value? Plus 250 minus this into 4, right? $150,000. Are you guys with me?
Yes, sir.
So $150,000 is the value of asset, and they are giving you option to purchase at $100,000. Right? So if you are using that car, you have already used it for 4 years, and if you are getting the car at a discount of $50,000, so more likely chances are that you will purchase it. Yes or no?
Yes, sir.
Right? So in this case of scenario also, even though you use for 48 months, compared to how many months? 120-month life of asset, right? So you have not used majority of the life, but still you have an option to purchase, which is a lucrative option, and that give like more likely than chances that you will go and absorb that option, right? In that case of scenario also, this car lease is considered into a finance lease, not operating lease. Make sense?
Yes.
So
Sir,
this
is there
is
any
what,
criteria for the life of the asset? Like almost like 50% of the life has been covered, right? So then it will be converted into the financial. Otherwise, if it is below 5 years, like the asset of a life.
no. There is no such criteria. These are the only 5 criteria which you need to keep in mind, right? So there is no such thumb rule here. It's all professional judgment, right? So here, like third option that we are discussing, there is an option at the end of the lease period to purchase the asset for a bargain price that is reasonably certain to be exercised. That means after 5 years, if you are getting an asset in just $1 lakh, $100,000, so more likely chances that you will be availing this option. Make sense?
Got it, sir.
Next is the present value of the lease payment using an appropriate discount rate exceed the substantial fair market value of the lease asset. So here what they are saying, the fair market value, FMV of asset. Let's assume FMV of asset is same as book value, right? And now you have, let's assume the lease payment $3,000, and you have used this asset for, let's say, um, 84 month. So that means 3,000 multiplied by 84. So you have already paid, let's assume 90 months. 90 months. So this is 90 months you have used that asset. What the life of asset is 120, right? So lease rental is this, lease period is this, and let's assume you have present value factor. Let's assume you have 5%, discount rate is 5%, right? So what you will do, we'll find out the 5% discount rate. 5%. And you do so yeah, maybe let's see. So 5% for 10 years is how much? 7.712, right? So here you'll be multiplying 3,000 into 12 into this, right? Sorry, my bad. So it's 90 months. 90 months is how many years? Plus 90 divided by 1, 2. So 7.5 years. Or if it is 8 years, then it is 96. Let's assume this is 96. I'm just drawing example randomly. So 96 is 8 years. So in 8 years, the value will be this much. Let's assume rental is 32. Right. So here what they are saying, just look at this. The present value of the lease payment using an appropriate discount rate exceeds substantially the fair market value of the lease asset. Right. So you have fair market value of lease asset $250,000. Right. Lease rent you are paying 3,300 per month. Right. So and lease period is 96 months, which is almost 8 years. Right. So lease rent total collected is 316,800, right? And the present value factor for the 5 year at the rate of 5% is 6.46. Right? Correct. So what is the total rent present value? 2,55,943. So which is more than the fair market value of asset? Yes or no? In
Yes,
this
sir.
case of scenario also, it is considered as finance lease. Finance lease, that means when you have paid the rental and the total rental which you have paid, present value of the total rental which you have paid is greater than the fair market value of asset. Then that arrangement is called finance lease. Right? Last is the asset is of specialized in nature. For example, I think we have discussed an example here last time also is of ambulance, right? If you're, for example, there's a Fortis hospital, for that you are making or creating an ambulance. So in all the parts of the interior parts of the ambulance, you have mentioned already Fortis, and even though external part of the ambulance, if you see here everywhere, you'll be writing and branding the Fortis hospital. Right, that means that ambulance cannot have ambulance do not have any alternative use, right? That can be used only and only by the Fortis. In that case of scenario also, such lease is called finance lease. Make sense? What are the 5 points to consider any lease into the finance lease? First one is the lease term is for the major part of the asset economic life. Second is transfer of ownership at the end. Third is option to purchase, which is a lucrative option. And then fourth is present value of the lease payment is more than the fair market value of the asset. Fifth one is specialized and specific category of asset which you are creating for the specific need of the individual organization, right? If any such 5 criteria meet, that means any one of the 5 met, then that lease is called finance lease. Right? Clear? What is finance lease?
Sorry, matlab, like
Mm-hmm.
if economic life, like if we have collected the rent more than the, the present fair market
No,
value, right?
majority of the economic life mean like 8 out of 10 years. You have already used that asset.
And sir, what about rent? Like if it has been collected more than the fair market value, then also
Then
will be
also,
like,
yes. Then also, yes.
okay, okay. Yes, sir.
Any, right? Any other doubt? Matthew, Harini, Manish? Clear? Any lease which is not a financial lease, any lease which is not comes under any of these 5 criteria, then that lease is called operating lease. Right? So an operating lease is a contract that allow an asset's use but does not convey the ownership right to the asset. Right? These lease allow business to use the asset without incurring high expense involving purchase it. Right? The lease that
Hello,
is
sir.
yes, Matthew.
Yeah, a doubt. Actually, last day I joined. Okay. So I didn't receive that book. So when I received that book, all these sentences are all there in that book also. Or do I
Mm-hmm.
need to write these, or so if I all
No,
these sentences are there in the
two
book,
things.
so I need to only underline those sentences, main sentences.
Yeah. Two
Yeah.
things, Matthew. One is, like you will get the access of the Surgeon Learning Management software, and that ebooks are also there, and the printed book also you'll be getting. Plus,
Okay.
like I'm sharing these notes, like after all classes, you can download and save these notes also. And later on, if you want to purchase this compiled note also, so that also you can purchase. That is available at just 650 rupees,
Okay.
right? Where you have all the compiled in a proper book format, right? Anything like like in the surgeon book, you already have available in the learning management. Have you got the access of LMS or not?
Just now I just opened the Google Drive of the recorded videos only.
No, yeah, that who is coordinating with you, Garima, Sachin, or
Sachin.
Sachin? Yeah. So just connect with Sachin. Like he will help you navigate through
Okay. Okay.
all the material, right?
Okay.
Mm. Right. Next is advantage of finance lease and disadvantage of finance lease. So it can be less expensive to lease than to borrow, because if you are taking on any asset on lease, generally you'll pay less money. It's like your rental expenses only to use that particular asset. Whereas if you go to purchase the asset, you may end up borrowing the big money, right? And on that money you may end up paying more and more interest. So here, even though you are paying lease rent, which is slightly more than the like value of asset which you are using, but compared to the borrowing cost, it will still be very less. Second thing is generally lesser do not require down payment. So here upfront, you are not required to make any bigger payment, and then you are not required to pay EMIs for the interest, right? So you'll be paying only the rental expense, which is being allowed for the tax purpose also. Any reductions placed in by the lessor, any restriction placed by the lessor are normally less restrictive than those by the lender. Because lender will be paying you the entire money to purchase that particular asset. Then he or she, or maybe the bank or financial institution, will put more and more restriction on the organization as well as on the respective asset, or there is always be a scope or chances of forfeit of the particular asset if you are doing any default. Then it may impact your overall operation. Whereas in case of lease, such risks are comparatively very less. Fourth is short lease period allow a company to avoid the risk of obsolescence. So if you are taking any machinery on a lease, right, and the lease period is short term, like 1 year, 2 year, 3 year, right? So then the chances or the risk of technologically obsolescence of the machinery is not yours, right? That risk you can pass on to the owner of that particular asset. That means if any technological get changed, then you can close that lease and move on to the new asset, which is technologically more advanced. Make sense? Fifth is if the land is lease, right? If do you remember like depreciation we have studied earlier, right? In the
Yes,
depreciation,
sir.
we are not charging depreciation on land, right? Because land is non-depreciable asset. Whereas if you have taken a land on lease, then the lease rent which you are paying is allowed for the tax purpose as expense, right? If the land is leased, the lease payment is a tax deductible expense. However, land is not owned or is not depreciable, right? Lazy provide for fixed rate of financing in that the lease payment is set for a life of the lease, and generally it is easier to pay lease than the borrowing, right? If you are taking a big loan, you need to go through the lot of formalities through the bank, whereas if you go to the lease arrangement, it is small lease rent agreement, right, which is less cumbersome and less expensive. Any doubt on the advantages of leases before we jump onto the disadvantages?
No, sir, clear.
Right, clear? Now coming to the disadvantages. In general, all the lease payment during the contracted period are required to be paid. Thus, flexibility is taken away from management in case of downturn in the business. So, if you have taken any working capital loan, so it increase with the increase in need, it decrease with the decrease in need. So there is some flexibility on the amount which you have borrowed and the interest you are paying. Whereas the lease rent is generally fixed in nature. Whether your business is growing or your business is facing downturn. Any which ways, lease rent you have to pay. Make sense? Yes, no?
Yes, sir. Well understood, sir.
Right. Second is, although the lease equipment is not owned, frequent maintenance for the assets are responsibility of the leaseholder. Even though you are not owning the asset, but if there is any repair maintenance required, like for example, you have taken a car on lease, right? So if that car require any repair, maintenance or service, you need to pay for that amount, right? Third is, over the life of the lease, the payment made on the lease are greater than if the assets were purchased on cash. So generally, lease rent, if you accumulate for over the period of time, you will see you have paid rent more than the purchase cost if you would have been purchased in cash, right? The additional amount of basic cost of the assets are similar to interest payment made to the borrowed fund. Last one is, there is no ownership during the lease period, thus no effective equity related ownership. So during the lease term, you may not have ownership, but at the end of the lease term, if you have option to purchase or right to purchase the asset, then the ownership will transfer to your hand, right? So these are certain disadvantages of the leases. So now we understood what is lease, what is operating lease, what is finance lease. The most important thing here is to understanding of the finance lease, the 5 points, right? If the lease fall in any of these 5 criteria, then it is considered as finance lease. Otherwise, all other lease are being considered operating lease. So then we understood advantage and disadvantage of finance lease, right? So far so good.
Yes, sir, clear.
Okay, now we are jumping onto the next topic called equity financing. Equity may be your common stock or it can be your preferred stock. Both will fall under the category of equity, right? So what is preferred stock? Any idea what is preference share or preferred stock?
Preferred stocks are stocks which have the preferred rights.
Yes. Preferred right of what?
Yeah, they will get the dividend at the right time, even if there is no profit to the equity shareholders.
Yeah, Kashish.
So it is basically like, if we say like the ownership of a company and, they have the right to claim from the, company's operation itself,
Who?
like shareholders.
Yeah, they have the fixed dividend, but the equity shareholders don't have the fixed dividend. The equity shareholders dividend depends upon the profit of the company.
Yeah, so more or less you're right. Like preferred, there are 2 category of stock. or you can say shares in India, but in US we call it stock. One is your equity stock or common stock, right? Both are interchangeable term. And one is your preferred stock, which we in India we call preference share, right? So preferred stock have certain preferences over the equity, but at the same time they have certain limitation over the equity compared to the equity. So let's understand one by one. Left hand side is more about preferred stock and right hand side is more about common stock or equity stock, right? So it has a characteristics of both debt and equity. So generally preferred stock is considered as hybrid instrument because it has certain characteristics of the debt and it also has certain characteristics of equity. So hence it is being generally called it hybrid stock or hybrid financing option. Preferred stock is riskier than the debt but less riskier than common stock. Why? Any idea? Why preferred stock is called more riskier? Because from the shareholder point of view, you will get the money after the repayments of borrowings, after the repayment of debt, right? But before the common stock, right? So when it comes to the liquidation stage, who will be getting the money first is your creditor, short-term borrowings, long-term borrowings, debts and bonds, right? Then after, if there is money left, then you'll be paying to the preference stock, and after that if there is any money left, that is being available for equity shareholder or common stock. Make sense? Matthew, Kashish, Harini,
Yes, sir.
Manish? Okay. So how the preferred stocks are being similar to debt? One is the dividend is fixed, same as like interest is fixed, right? Preferred stock has priority over the common stock upon liquidation. So upon liquidation, first company need to pay to the preferred stock. If there is remaining amount, then that amount will go to the equity shareholder, right? Second is preferred has priority over the common stock upon liquidation. Sorry, third is preferred stock have no voting right. So preference share generally do not have voting right. Voting right comes with the equity share, right? And now in the equity also there are both category with voting power and without voting, right? How it is similar to equity preferred stock? First one is preferred stock increase equity like a common stock, your share capital increase, right? So as your share capital increase, your credit worthiness also increase, right? Original investment does not need to be paid back. That means once you pay the money as a preferred stock, most likely that you are not going to repay the original money, right? Unless and until there is a liquidation, first the amount you need to pay to the loans, right, or the borrowers. Then after remaining amount left will be payable to the preference shareholder and then to the equity shareholder, right? There is no maturity date. That means money which you have granted or provided in the preference share to the company, then it is being generally considered as money for the perpetuity, right? Fourth is preferred dividend are not deductible. So the dividend is always be calculated on profit after tax, not profit before tax. Hence, there is no tax benefit, right? Liability of preferred stockholder is also limited to the extent of the amount they have invested. So as you know, like we all know, the company is being considered as a separate legal entity, right? So any shareholder, whether it's common stockholder or a preferred stockholder, is not liable personally for any liability of the company, right? So hence the preferred stock also have limited liability. There are few varieties of preferred stock. First one is participating and second one is non-participating. Participating preferred stocks are those stocks which have right to participate in the management and decision taking of the shareholder, whereas non-participating preferred stock do not have any such right. Right? Second is convertible preferred stock and non-convertible preferred stock. Convertible preferred stock are those stock which will be in future can convert into common stock or equity stock. Non-convertible preferred stock will always get redeemed after such time, right? Third is cumulative and non-cumulative preferred stock. Any idea what is cumulative preferred stock? What is non-cumulative? It is very easy. Kashish, Matthew, Harini, what is cumulative preferred stock and what is non-cumulative?
No, sir.
Cumulative preferred stock are those stock where dividend you can accumulate. If, for example, in year 1, the company do not have sufficient money to pay preference dividend, then in year 2, if the company do have good profit, in year 2, they can pay dividend for year 1 and year 2 both. So that is called cumulative preferred stock, where dividend get accumulated period over period, and when the company have money, they will pay the dividend. Non-cumulative preferred stock are those stock whose dividends cannot be accumulated. Right? If in any current year dividend is not paid, then that is not required to be paid in future year. Make sense?
Got it, sir.
How do you calculate the cost of preferred stock? KP, that means cost of preferred stock, is equal to DE divided by PP. What is DE? Is preferred dividend, right? D means dividend, right? And PP is price. So that means dividend divided by price of preferred stock will give you cost of preferred stock, right? When there is a floating cost, when there is no floating cost, that means there is no additional cost. When there is a floating cost, then dividend divided by 1 minus floating cost into price, right? Floating cost mean if your price are significantly changing period over period, date over date, right? Then you'll be using floating price method, right? Any doubt on preferred stock? Shall we jump onto the common stock?
Yes, sir.
So common stock are the type of security that represent ownership of the company. Common stock are generally owners of the company, right? Make sense? Common
Yes, sir.
shareholder,
Yes.
common shareholder have the right to elect board of director, approve changes in the corporate charter, which is like in India we call AOA or MOA. Have you heard this term? Article of Association, Memorandum of Association.
Yes, sir.
Right? So that is called charter. Third is shares in the company profit and loss. So they will get the share in the company's profit and loss. Right? Fourth is share in any remaining assets upon liquidation. So when you are liquidating asset, first you repay all your short-term and long-term borrowings. Then you repay your preferred stock. If there is any remaining amount, that you will consider as your own money. Fifth is maintain a proportionate share of ownership in the company should additional stock be issued. That is preemptive right. That means if company is planning to issue additional share, first preference will be given to the existing shareholder to purchase the additional share. Right? When existing shareholder forfeit the right to purchase, then it will go to the general market. Advantage of equity. First one is dividend has the flexibility. as there is no legal requirement to pay dividend, right? Second is no maturity date for repayment. Third is it increases the creditworthiness of the organization. Fourth is an attractive investment for the firm with a solid growth or often provide a higher rate of returns to the investor than debt. But what are the disadvantages of investing in common stock and equity? First one is ownership and EPS are diluted, right? If you are increasing number of share, it will automatically decrease the earning per share, right? WACC also increase because if you are raising more and more equity, so generally cost of equity is higher than the cost of debt. So it will increase the WACC, weighted average cost of capital. Third is underwriting cost can be high. If you are underwriting your stock, right? So underwriting cost will also increase. Fifth is the common dividend are not tax deductible. So common stock dividend is always after tax, profit after tax, before it went to the retained earning, right? So these are certain disadvantages of common stock. Right, so clear what is preferred stock, what is common stock or equity stock? So far so good?
Yes, sir.
Okay, so next one is retained earning. What is retained earning? What is retained earning? Please, come on.
So it is basically the profit which has not been distributed to the shareholders.
Yes,
Yeah,
so
Like
retained,
particularly the
that is basically
company's
used for the
profit.
company's future
Yes.
investments or something,
yeah,
operations.
yeah, very true. So retained earning is basically the profit that we are not paying to the shareholder and we are reinvesting into the business, right? For further growth of the organization. That is called retained earning. So just look at the definition which is mentioned here. Retained earning are the gap profit that have not been paid out to the shareholder. The cost associated with the source of funding is the opportunity cost for a common stockholder. So what is the cost? Basically opportunity cost. Whatever the money you are generating through the revenue, right? Based on the investment made by the shareholder, if they could have made a better investment somewhere else, right? So that loss is called opportunity lost, right? If the earnings are retained in the company as opposed to the issue of new common stock, floating costs associated with the new issue are avoided. That means when you need money in the organization and you reinvest through the retained earning, then you are not required to pay any additional cost for underwriter, right? So that will get reduced. Thus, the cost of retained earning is generally lower than the cost of new issue of common stock. What are the advantage? It is like internal source of financing, right? And preferred due to ease of availability and lack of additional cost, like we were discussing. Second is it helps in improving the credit worthiness. That means company is growing, company is earning profit. It's not a loss-making company. It increases your credit worthiness. Third is no interest or dividend need to be paid. Right? From the retained earning, you are not required to pay any interest or dividend specifically. But what are the disadvantages? Earning retained in the company cannot be paid out to the shareholder. Second is the greater negative impact on WACC. As your retained earning increase, that means you are involving more and more internal fund. As you are involving more and more internal fund, the cost of internal fund is much more than the borrowing cost. Hence, the greater negative impact on weighted average weighted average cost of capital. Right? Make sense?
Yes,
Any
sir.
doubt on retained earning?
सर ये लास्ट वाला पॉइंट में नेगेटिव क्यों होगा सर इम्पैक्ट?
Because cost of capital of equity and retained earning is higher than the debt. So when you are increasing retained earning, So your cost of capital will increase.
Okay.
Let's do few practice question. A firm that design its cost structure to include high degree of operating fixed cost than variable cost by electing to pay salaries instead of commission is magnifying the impact of each additional sales dollar using the concept of combined leverage, financial leverage, operational leverage, or financial leverage. So understand the question properly. What they are saying? The firm that design cost structure to include high degree of operating fixed cost. That means you are increasing your fixed cost. Then the variable cost. That means what they are doing, they are paying salary. So for example, earlier you are paying a salary of $10,000 plus you are giving, let's assume, $10 on achievement of each sale as a variable component. So normally one person was able to achieve 100 sales multiplied by $10, that means $11,000. Normally a salesperson was able to achieve that cost. But now they are saying we do not need to calculate the variable. We'll give you 10,500 fixed, right? In that case of scenario, your fixed cost has increased compared to variable cost, right? So where this fixed cost will go, in operating activity or financing activity?
Sir,
Where
operation में
the
जाएगा वो
salary
तो
cost will go, operating activity, right? So it
Yes,
will
sir.
result into which out of these four options,
The third.
right? Operating leverage. So
पर
it will
फाइनेंसिंग में
impact.
भी जा सकती है ना क्योंकि we
No,
have
no. If you are taking any borrowing and there would be any interest cost, if you are taking any financial decision, then it will go to the financial activity. Otherwise, it will continuously going in operational activity,
okay.
right?
Got it.
So which option is correct? Third. Everyone
Yes,
agree?
yes, sir.
Right. Next is which one of the firm's sources of new capital usually has the lowest after-tax cost? Common stock, bond, preferred stock, or retained earning? Which one out of these four have lowest after-tax cost?
The bond.
Why? Because bond interests are allowable expense. Right?
Yes, sir.
Make sense, everyone? Manish, Arun, Matthew,
तो
Harini?
वैसे भी उसमें रेट ऑफ इंटरेस्ट भी कम होता था आफ्टर टैक्स भी
Yeah, cost of capital is generally low for the borrowing compared to equity and retained earning or including preferred stock.
यस
Third
उसमें तो सिर्फ
option
बाकी
is
सब में तो सर 30% होता ही होता है चाहे
yeah,
वो प्रेफरेंस स्टॉक हो या कॉमन स्टॉक हो नियर अबाउट एंड सर
yeah,
बॉन्ड में नियर अबाउट लेस होता है एज कम्पेयर टू अदर
yeah. But for more important for us is the tax benefit,
यस
right? So generally that is 30% to 35% tax benefit. Third question is a company recently issued 8% preferred stock. The preferred stock sold for $40 a share with par of $20. The cost of issuing stock was $5. What is the company cost of preferred stock? So what they are saying, you have preferred stock market price $40 and then you have par value $20 and cost of issuing stock is $5. What is the company's cost of preferred stock? What is the company's cost of preferred stock? How do you calculate? How do you calculate this? Let's do the math here. So here what they are saying, company has recently issued 9% preferred stock. The preferred stock sold at $40, right? So 9% preferred stock, right? And par value is 20. You sold at 40, right? So to them, how much dividend you'll be paying? Market value is 40, right? And how much dividend you'll be paying? You'll be paying 20 into 0.09, right? $1.8.
Yes, sir.
And this $1.8, right? And how much money you are paying? $5. The cost of issuing the stock is $5. Cost of issuing stock is $5, right? So what is the money you are getting? Money you have collected 40 minus 5, $35, right? This divided by, right, 5.1. So this option is correct option, right? Makes
सर एक बार
sense?
फिर से नो सर नहीं समझ आ रहा
Okay, normally. So they have given par value of the stock $20,
यस सर
right? Market value is given $40, right?
यस सर
And they have said the cost of issuing is $5. That means what amount you are recovering? 40 minus 5, right? You are getting cash in hand. How much? $35.
यस सर
And how much interest dividend you will be paying? 9% on par value. So 9% on par value is $1.8. So total dividend you are paying is $1.8. Yes or no?
यस सर
But actually, how much money you are receiving? $35. So what is the cost of preferred stock? $1.8 divided by $35. Make sense? Huh? Matthew, Kashish, Harini? Clear? Yes, no?
यस सर
Right?
Yes, sir.
So 5.1%. Fourth answer is correct answer. Right? Clear?
यस
Okay. So shall we take a close over here, or shall we continue with the new topic, cost of equity? Or maybe we can cover up this topic tomorrow.
कल ही कर लेंगे सर बेटर
Tomorrow, actually, I am traveling to Coimbatore. So